Thanks for welcome everybody. Thanks for joining today. Glad to have you. And the project we're going to talk about is 617 West Riverview Avenue. That's in Dayton, Ohio. You can see the building there in the back. It's located right across from downtown Dayton. That's the Little Miami River right there. So 30-unit building that we've acquired. So let's get started. Move through.
Yeah, Nate, it's an interesting one. I'm excited to go over it with you and kind of share this. Let's do it.
Okay, great. So here's just a couple things that we're going to go over today, and you can dig into this package at your leisure. We'll send this along to you. So here it is. You can see it's great location, literally riverfront. It is one of the closest buildings to the river. 30 units. So 30-unit building, and this is a very important slide to just show my company, Peak 10. We've been in this market since 2016, and we have 400 units that we've been managing. Just to sort of set the lay of the land here, for those that are not familiar with Dayton, downtown Dayton is to the right of the screen. Over here on the right, you have the Dayton Art Institute, the Masonic Temple, and the Greek Orthodox Church. And this is the Grafton Hills submarket, if you will, literally right across the street from downtown, or right across the river, my bad. And so Peak 10 Group, we've been managing 400 units. We bought into this neighborhood. This is a great neighborhood. Tons of pride of ownership. That's the thing that attracted me to invest in 2016. And we've amassed 400 units. We have Rockwood here on the left, Riverstone here, and its sister building, Executive House, all managed out of Park Lane, which is kind of the flagship. That's where the leasing staff and the main leasing office is. And so it's just a natural addition to purchase the Riverview property. It is literally adjacent to 400 units that we've been managing. So we really control the submarket. We're the largest owner, and this is just a great addition to it. And there's a number of different inherent benefits, okay, to this. This Riverview has been a toxic asset in the neighborhood for quite some time. So getting control of this property will lift up the neighborhood and will really improve it. So we can come back to this, but that just sort of sets the lay of the land, and we've got a ton of experience. We dominate the market from setting rents. So that's one of the main reasons we really like this project.
Well, on top of that, I think and what makes this so attractive, obviously, with you being so prominent in the area and just having it managed, right out of Park Lane, just like your other units, and having that management in place, and it just flow right in and go.
Yeah. One real quick, I forgot to set the stage. So Darren is my partner. We're the general partners on the deal, and I run the management company. So just a little bit of a little background. Okay, here's some of the deal facts. All right, we've actually already acquired the property. We paid cash for it. We closed a couple days ago at the end of May for $950,000. We got in at a great basis. That's about $31,600 a door. Now, why so cheap? Well, it needs a ton of work, and we need to vacate the building and re-tenant, do our rehab. We have a $500,000 rehab budget to do the work. Bones of the building are solid, built in 1957, and so a lot of work to be done. We need to exit, get the tenants that are in there out, and do the rehab. So 5-year hold is the plan, and we would put a $500,000 construction loan on it right away. So, and the equity raise is $1,050,000. So that's what we're sort of going for. Here's the unit mix. So 30 units, 14 studio, 12 ones, and 4 twos. One of the things I want to point out is in the current portfolio that we have down there, we don't have a lot of studios. So this is going to be a great addition because now that gives us more studios, which we can charge a higher rental rate for. So this will really benefit us that we'll have another more affordable, higher rent per square foot option in the mix. Here's the sort of the executive summary. I did touch on my group, Peak 10, Darren's group, 741 Capital Ventures. Some things about the building. Let's see, 31.6 per door. We're buying it 950,000. We're going to raise 1,050,000, and the plan is to hold for 5 years. And we think that we can exit this property in 5 years, or we'll hold it. We can talk about that. We think the value there is in 5 years is 2.23 million over a 4-year hold. Okay, now to the fun stuff. Business plan. We have some life safety issues that we need to address pretty quickly, and we'll go to the timeline here shortly. So we've acquired it. As is, where is, there's some life safety issues that we got to address immediately, work with the city of Dayton, housing and fire. We will start renovation on it. Actually, some of the units in 2015 were renovated, so we don't have to do all of them, but we need to get in there and check it out and really see what we have to do, and you'll see some photos of those later. So we'll clear the building out, we'll fix the life safety issues, and we'll start leasing the building back up. We'll stabilize it, and then we'll operate it. I'm going to go to the next slide, I think, which is the timeline. Again, so here we are, June 2023. We'll get control of it. We'll start the rehab. We think that we can start leasing some units by October of 2023. So in the pro forma, we've given ourselves, a few months, and we're counting on minimal income in the calendar year 2023. So we've got some flex in there. We'll see what we have, but as soon as we can, we'll start leasing, and we'll go floor by floor. And then we'll rent it up, we'll operate it, and then we can decide what we want to do in sort of year 5. Darren, you want to jump in here and add some stuff?
Yeah, I think the overall approach is, very, very conservative. And I think we can up that with getting these not only renovated, but also leased up. But our underwriting is really keeping everything really, really conservative, which these numbers still pop, which we'll dive into a little bit later and make it conducive for the investors as well. So it's a great project.
Yeah, I think the conservative approach is the approach we're taking today. We're not going to load this thing up with a lot of debt. We want to have some cash flow that we can hit on. But by taking the conservative route and only doing a $500,000 5-year fixed 6.75 loan, we're not beholden to a huge, to a bank. Gives us a lot of flexibility, which is really where I think we need to be in this weird environment that we're in today. So moving on, here's if you get a chance, you can, depending on how you get this, you can either scan the QR code, that'll take you to a video that has a drone flyover, which shows the buildings that we already own and manage there, as well as, or you can click on the link. And so short little video, but gives you a really good idea of its location. Here's the footprint of the building. One of the things that is important in this slide, we don't have a lot of parking, but there's plenty of street parking available. And the roof was new in 2014 or 2015, and we've had that warranty transferred over. So that's a big CapEx expense that we don't have, and we can utilize that warranty. Not a lot of big footprints, so not a ton of exterior expense from a landscaping standpoint. Very tight site. There is some underground parking that we're going to try to monetize here, about 5 or 6 spaces under the building. It does have an elevator in the building, which does add a little bit of expense, but I've got 4 other buildings. I know about elevators, and so I'm seasoned in that. But it is an additional expense that you don't normally incur on a 30-unit building. But solid bones, solid building. Great. Here's some beautiful before pictures. All right. Now, again, the reason why we're buying it at a low basis is because it has been mismanaged by a California owner for the past year, and they just don't know what the hell they're doing. That's where we step in, and we do know what we're doing. And, in my previous life, so it is a heavy lift. And in my previous life, my family business, I've been in this business for 25 years. I used to do a lot of buildings like this. Okay, so I've turned around a lot of buildings, so I'm very seasoned at this. So this kind of stuff doesn't really scare me. Might scare some people, but we've got a cadre of vendors servicing our existing portfolio. So we will put a project manager in place and go through, decide again that kitchen you look at there on the right. The boxes are probably still good. We'll try to salvage those if we can. New countertop. We'll do some, you know, we'll do a new lighting package, a new countertop package, maybe a backsplash. We'll do the floors. We'll go through all the units and decide. Like I'm looking at that, and that tub is probably still good. And so we're going to try to find ways to reduce that $500,000 rehab budget. But again, old building, a lot of rehab. We got to have a big budget because there's always cost overruns and unexpected things in a big building. But we'll work to get that, to try to get that down.
And it's, we're already in motion with meeting with contractors, and it's already going. So it's really just narrowing down and then putting that in motion and going. So hopefully we can move to these units here, which previous owner, they're not really at this condition now, but this is kind of the focus and where we're going.
Yeah, good point. So, 15 of these units were renovated in 2016, but we really need to go in and get a full inventory of what's salvageable. And we've got some squatters in the building, so it is a challenge to get them exited out of there in the responsible way. But this is the level that we're shooting for: LVT flooring, brushed nickel sort of lighting package, if you will. Not sure if we'll be able to get to stainless steel appliances. Those are pretty expensive, but either way, we're going to provide a nice quality interior. A lot of the windows in the building have been replaced and are new, so we don't have that expense. One of the big in the rehab cost, we have the fire panel needs to be addressed, and there's some plumbing issues. So we do have some big CapEx expenses that we've got to face. Part of the reason why the budget's so high. Again, just a little, you can see what a great location this really is. That's downtown Dayton in the background. Literally, that is a 2-3 minute walk into downtown. And one of the things there's a lot of great stuff happening in downtown Dayton, and that's why I invested here. Darren actually lives there. He knows the amount of investment that's been put in over by the Dayton Dragons ballpark by Crawford Hoyne. And those guys keep investing in downtown, keep building new stuff. They keep raising rents, and we're a nice, affordable option just across the river. So we let them do all the hard work, raise the rents, and then we provide an affordable option, and naturally that sort of brings us up. So we've really benefited from all the investment in downtown Dayton. Am I missing anything?
No, I think the big thing obviously is the location, and it's a great view. All the 2 bedrooms are facing the downtown, and that's what you can't buy. So we're really set and excited, on that front.
I'm not going to spend a ton of time on the market overview. We've been in the market. We know a lot about the market. We know the submarket. We know the rents. You can dig into this sort of on your own leisure. Let me jump back one thing about the market. I will say, you listen to the news and you listen to what's going on in real estate, and this is a great time to be in the Midwest, okay, for a number of reasons. The steady, slow Midwest growth that we have here is exactly what we want right now. We're not in boom and bust. As of I think it was last week, 2 weeks ago, Columbus, Cincinnati, Indianapolis in the top 10 for rent growth year over year for apartment rent growth. Not crazy, 20%, just steady, nice, slow. So I love where we're at right now. This is when it is just such a benefit to be in the Midwest with your investments. Not the case you see in some of the other markets, Nashville and Phoenix, where there's going to be a massive oversupply, which is going to put a lot of pressure. We just simply don't have a lot of that in the Midwest, which is great. So wanted to point that out. Again, we talked a little bit about the plan here. We've got a number of great options, and that's why we've chosen to be very conservative, do the $500,000, call it construction loan, 18 months of interest only at 6.75. Once we've got that, then we've got a lot of options here. So we can choose to hold that um, for a few years, or we can do a cash out refinance. And I think the important thing is we're going to constantly be monitoring the interest rate market and the environment. And there could be an opportunity that we would refinance earlier and return some of the initial investment. So this gives us the flexibility to do that, which is right where we want to be. So with a big value add, I don't think that because there is uncertainty, I don't think that the plan today is to cash 100% of our money out and lever the heck out of this thing. Let's just be conservative and have ourselves a lot of options.
Which that's really what's attractive to this whole deal and the market that we're in, and to have these options. So again, kind of excited with this approach.
Great. Here's a little bit about me. I've touched on this. I've been in the business, grew up in a multifamily family, been in the business for 25 years. I'm both an active owner, investor, owner operator. You can see I manage the 400 units there already. I'm also a limited partner investor in a lot of other deals. I've done $450 million worth of transactions. I'm involved in the Greater Dayton Area Apartment Association. I was vice president there for a couple years, sit on their legislative committee, president of the Columbus Apartment Association in 2016 and 17. Have a CPM designation, which is like the MBA of the property management world. And so, I've got a lot of experience in this business. So just wanted to sort of, point that out. Again, here's a little bit about my property management company. I think one of the things that is very important about my property management company and this one, in the Dayton portfolio, we've been able to keep the turnover numbers way down. We're averaging around 37% annual turnover, where you have an industry average of 40 to 45 to 50%. And so that's really what we have done a great job of, is keeping the turnover cost as low as we can by keeping people longer. People like to rent from us. We have the property management team. Most of my staff has been with us for 5+ years. So I really pride myself on the property management side, and keeping tenants for a long time. And I think that's going to translate really well to this building. Once we get people in there, they're going to stay with us. They like to rent from us. That's actually the lobby of our Park Lane building, right now up on the top.
And really, Nate, you're able to hold on to your tenants longer than what the market tells us, correct?
Yeah. I mean, like I said, the industry average is around 45% annual turnover. We're down around 38%, 37%. And so that's a real big win for this. Just a couple things about I have a full team here at Peak 10. And so we're invested in a number of different states. We also do the asset management. So we'll manage the investors. We have the property management. I'm also into the new construction development side. So I have a full team to back us up and provide reporting back to you, the investors. So we have a full staff to do that. Again, here's a little slide. I touched a little bit about Darren and myself. So we're the core general partners in this. The appendix, here's just a quick little slide with some of the deal terms, some of the loan terms. I've already talked about those. The property. We do have some fees involved here that I want to disclose to you. We have an acquisition fee. It is a small building, and a small building is about the same amount of work as a large building. So at 2% of the purchase price acquisition fee is not a lot of money. Trust me, this was a good bit of work on this one. And if anybody wants to break it down, I should probably do a whole podcast on this one. Darren and I can talk about the craziness of this deal. We have an asset management fee of 3%. Now, 3% might seem like a lot, but look at the gross rents. It comes out to about $400 a month, which is not a big moneymaker. So, there's not a lot of fees being paid because it's a small deal, guys. It's not a big one. So, not a big chunk off there on the fees. And we're not charging we have a $500,000. We're not charging a fee to manage the construction as well. So, just wanted to sort of point those out. Okay, here's some of the important investment terms. We're going to raise $1.05 million on here $500,000 renovation budget. We're projecting an average annual return on your investment of 16.4. Projected equity multiple 1.72. Projected IRR 22.9. We're looking for accredited investors. Again, I talked about the hold, $50,000. Darren, you want to add anything here? I'll break down the LPGP thing in a few minutes, but anything you want to add on here? Did I miss anything?
I think we've talked about a minimum investment, and I think we're looking to stay under that 20% realm as far as the maximum, which I believe, what is that 20%? Just so we're not taking LP's requirement to be on the loan. So we'll take the risk on that side and be on the loans, but I think you covered everything.
Yeah, good point. I think what Darren is saying is that we sort of have to cap investment because the group that we're working with, the bank, the lender we're working with, if someone wanted to invest in the entire part of the deal, then you have to sign on the debt, and I don't think you want to do that. Let Darren and I do that. So if you do want to put a bunch of money in here, talk with me. We can talk about some different things on that, but that's why the investment is sort of limited, because I don't think you want to sign on the debt. Let us do that. Becomes a challenge. So. Here's some of the numbers on the deal. I think I've recapped some of those. You can see this is just sort of our pro forma, and dig into this. We can provide more information, but spend some time looking at this so you understand it, and ask plenty of questions. Again, year one, we don't have a lot of income coming in. You can see that down here at the very bottom. That's just because we're doing rehab, and we're not going to count on a ton of revenue for year one. And that sort of ramps up. Year two has rehab in it too. We hope to beat that. But anyway, so. All right, here, some of the investment we talked about, the GP group, that's Darren and I. Investment structure, we've already purchased the property under 610 Riverview P10 LLC. We would create another LLC that would be the limited partners. That's where the investors, would come in. And the way that the profits and distributions would be split is the limited partners would get all the funds until such that 100% of your initial investment has been returned. At that point, then the split of profits becomes 70% to the limited partners, 30% to the GP partners. We don't anticipate that happening until a capital event. And so really, the limited partners are getting all the profits. We'll have some fees along the way, but our portion comes sort of at the end after we've done our work and we've returned your funds. Anything on here I need to add, Aaron?
No, you covered it. We don't get paid until you get paid.
Yep. Here's all the great fun stuff. Read that. Got to have that in there. And this is just sort of our recap slide. Again, lots of this stuff we've talked about, but this does have some of the important numbers. $950 purchase, $500,000 rehab, 31.6. 31.6 per door. Down at the bottom, you've got the projected cash on cash return of $100,000 investment. First year, we're going to be very conservative, and we don't necessarily. We'd like to have some cash flow, but I'm not going to count on it in year one. But year two, we start to get to some cash on cash return, 10%. It looks like about an average of 10.5% of cash on cash return on your investment over the years. And then at the end, we have the sale or disposition if we choose so. That's sort of the big kicker. Again, we talked about the 22.9 IRR, 1.72 multiple, average return on equity of 16.4%. There's down in the bottom, we recap the GP-LP split of profits. One of the things I want to just talk about a little bit of timing maybe, and then Darren, I'll let you add in, is we've already bought the building, so we'd like to get this out there, get a soft commitment from you as quick as possible, but we'd really like to have cash coming in here probably within 21 to 28 days, just because we bought the building in cash and would like to return some of that so we can sort of get our money back in play. Anything else today?
No, I think we covered it all. Certainly look forward to talking to you individually and really dive into this more. more with to answer any questions and kind of move forward. It's an exciting project, and look forward to working with you guys.
Yeah, great. Well, thank you all very much. Appreciate it. But yeah, feel free to reach out to either one of us. Our information is right here, and love to talk with you and see what you think. So, all right, great. Thank you very much.